Okay, we're going to expand Friar's Hormuz divergence model, the core structural macro thesis. We're going to extend it into territory that most of the mainstream media isn't covering. What happens to the US financial markets, and specifically the blockbuster IPO pipeline, when Gulf sovereign wealth funds are forced to repatriate capital? This is not a theoretical risk. We now have SEC filed evidence. It is already underway. By the end of this presentation, we will understand why the same geopolitical shock that is driving oil prices higher is simultaneously tightening the capital pipeline for SpaceX, OpenAI, and Anthropic's IPOs, and what the doctrine-compliant position response looks like. The scale of the GCC capital in the US, how the Gulf became Wall Street's largest sovereign creditor. We need to appreciate just how much of it has arrived in the US. These three numbers frame the dependency. Structural shift. Context is critical here. Chinese foreign direct investment into the US collapsed from $55 billion in 2016 to just $3.8 billion in 2025, driven by geopolitical pressure and decoupling. The GCC sovereign wealth funds quietly filled that vacuum. In 2026, Saudi Arabia and the UAE had risen from outside the top 20 global FDI destinations to inside the top 10. The US is now structurally dependent on Gulf sovereign capital as a core funding source for AI infrastructure, private equity and venture. This is not a peripheral flow, it is load-bearing. The Council on Foreign Relations published a detailed analysis in May 2026 titled Disappearing Gulf Capital. The $12 billion figure on the right card is the red flag. Note the warning icon. This is the first quarter 2026 confirmed 13F figure. Saudi Public Investment Fund confirmed a liquidation trend. This is the most important new evidence we'll be looking at today. The Q1 2026 13F filing from Saudi Arabia's Public Investment Fund was released to the SEC and confirms what the Q4 2025 filing first signaled. I'll let you have a look at those numbers. 2 data points constitute a trend. 3 consecutive quarters of reduction filed with the SEC by the world's largest GCC sovereign wealth fund constitute a signal, not noise. The bar chart on the slide uses color coding deliberately. The navy bars represent the long plateau. The gold bars represent the last 2 quarters of obvious decline. And the red bar is the first quarter 2026. The visual tells the story without words. That is intentional. The Alurian exit is also noteworthy. This is not a position reduction, it is a complete exit. The PIF is not trimming around the edges, it is consolidating to its highest conviction remaining positions and shedding everything peripheral. Okay, now a little critical question. The Saudi PIF reportedly negotiated a $5 billion anchor stake in the SpaceX IPO before Q1 2026 fiscal pressure was visible in the 13F data. The Q1 2026 filing postdates that negotiation. Does the anchor commitment survive internal PIF capital allocation review as the SpaceX prospectus is filed? Watch SpaceX S1 registration statement for anchor investment confirmation, reduction or quiet reductioning. This is the canary. The fiscal squeeze. The PIF 13F data does not exist in isolation. There are three structural forces simultaneously pulling the GCC capital home, and they are mutually reinforcing. Column 1, revenue collapse. The Strait of Hormuz closure has disrupted hydrocarbon exports, the primary revenue source for all 6 GCC states. Tourism revenue, which were a major diversification success story for the UAE and Saudi Arabia under Vision 2030, have been severely disrupted by the conflict. Punters have lost confidence in safety there. GCC fiscal break-even oil prices range from around $70 to $90 per barrel depending on the state, a figure that becomes irrelevant when tankers cannot transit the strait to deliver the product. Column 2, domestic capital needs. Infrastructure repair costs from conflict damage are running into hundreds of billions of dollars, and the war hasn't finished. Defense spending has surged across all GCC states simultaneously. Dubai's Crown Prince approved a $272 million business relief fund. The UAE Central Bank rolled out a banking resilience package. These are crisis response instruments. Column 3, sovereign credit pressure. Moody's downgraded Bahrain's outlook to negative in late April 2026. Talks are reportedly underway between the US Treasury Department and certain GCC governments about emergency dollar liquidity provision if Hormuz disruption persists, which it appears it will. When a government needs emergency dollar liquidity from the US Treasury, it's simultaneously less likely to be deploying dollars into US venture capital and private equity, or AI IPOs. The public messaging from the GCC governments has been reassuring. The UAE ambassador's Wall Street Journal op-ed affirming the $1.4 trillion commitment is firm is a case in point. But governments always say this. Check out Trump. Watch the behavior, not the statements. The C variable. This is our analytical edge. The A variable, C variable framework is the core of Friar's research approach. Markets price the obvious first-order victims while missing the physical supply constraint mechanisms that actually determine medium-term price action. In this case, A variable, fully priced, energy disruption, oil price spike, energy stocks rally. Every Bloomberg terminal in the world is watching this. There is no edge here. C variable, not priced yet. The GCC Sovereign Wealth Fund withdrawal, US AI and tech capital pipeline narrows, hyperscalers pivot to debt financing, multiple compression across the QQQ and Nasdaq complex. Stage 1, US listed equities, already visible in the PIF 13F filings. This is occurring now. Stage 2, VC and PE funding rounds. Gulf LPs reducing commitments means fewer dollars chasing startup valuations. The pipeline narrows on a 6 to 12 month lag from the fiscal squeeze. Stage 3, financial intermediary fee income. Blackstone, KKR, Apollo, all dependent on Gulf LP capital for fundraisers. Reduced GCC participation means smaller funds and lower management fees. This is the BX KKR IPO bear watch thesis. Stage 4, hyperscaler debt markets. If GCC's sovereign wealth funds reduce their US Treasury and investment-grade credit buying, the cost of debt rises for Microsoft, Amazon, Google and Meta, all of who are now debt funding their CapEx, their AI CapEx. Stage 5, IPO anchor demand. SpaceX, OpenAI and Anthropic are all targeting IPOs in the same 12-month window, with the GCC sovereign capital as named or expected anchor investors. The IPO pipeline. This is new analysis not covered in the original GCC report in the video earlier, and it is the sharpest edge of the thesis. 3 of the most anticipated IPOs in market history are all targeting a 12-month window, all at $1 trillion scale valuations, all with explicit or implicit GCC sovereign capital dependency. We'll look at them case by case. SpaceX, risk high, target valuation 1.75 trillion, target raise 75 to 100 billion, IPO date June 2026, coming up soon. Saudi Arabia's PIF is reporting negotiating a $5 billion anchor stake on a $75 to $100 billion raise. That's 5 to 7% of the entire offering sitting in one sovereign check. Norway's $2.2 trillion sovereign wealth fund, the world's largest, is also in dialogue about participation as a sovereign anchor demand is structural to making the pricing hold. The valuation implicitly assumes cheap energy, compliant GCC sovereign wealth, and effectively infinite liquidity, 3 conditions that are simultaneously under pressure. OpenAI, risk high. Filed IPO prospectus confidently with the SEC on 22nd of May 2026. Goldman Sachs and Morgan Stanley leading target listing September 2026. Sam Altman personally travelled to the UAE to participate in a sovereign wealth fund investment talks as part of the latest fundraising. I'm not sure that would be a positive for the IPO because Sam Altman is one of the dodgiest fellows I've ever come across. Abu Dhabi's MGX and G42 are co-investors and are building a 5 gigawatt OpenAI campus in the UAE, drawing enough electricity to power several million homes. G42 is also investing in OpenAI data centers in the US through a Microsoft partnership. The GCC relationship is deeply bilateral, not just financial. And Anthropic, risk medium high. Abu Dhabi's MGX is named co-lead investor in Anthropic's Series G, closed $30 billion at $380 billion post-money valuation in February 2026. A further round reportedly now targets $900 billion plus valuation, which would make Anthropic the world's most valuable private AI company, ahead of OpenAI. At these valuations, the question is not whether GCC capital matters, it is who else has the balance sheet to write checks of this size. The GCC dependency dynamic tells us something important about the post-IPO price action risk. If anchor investor commitments are reduced or restructured between now and listing, the IPO pricing will reflect it, and that has second-order effects on the entire Nasdaq complex. The systematic risk. This slide applies Charles Kindleberger's Anatomy of a Financial Crisis from his classic 1978 work, Manias, Panics and Crashes, to map where we are in this cycle. Kindleberger's framework identifies 5 phases. Displacement, the external shock that creates new investment opportunities and disrupts the prior equilibrium. Here, the Hormuz closure, the geopolitical order that underpinned GCC to US capital flows has changed overnight. Credit expansion, the period of easy money that inflates asset prices. Here, $120 billion per year, the GCC sovereign capital flowing into the US AI tech PE private equity, inflating private market valuations to levels that require continuous inflows to sustain. Euphoria, the peak of the mania, where valuations disconnect from fundamentals. Here, $1.75 trillion for SpaceX, $900 billion for Anthropic, $852 billion for OpenAI, all in the same 12-month IPO window. This is the euphoria phase made manifest. Distress. We are here. The first evidence of reversal. The PIF-13F data, the Allurian exit, and Meta-Operate gift withdrawal, the Moody's downgrade, these are all distress signals. Revulsion, the abrupt repricing of assets that were inflated during the expansion. The IPO window is where revulsion will become visible if it occurs. This is technically a sudden stop scenario, a concept developed by Guillermo Calvo in 1998 in the context of emerging market capital flow reversals. The sudden stop involves a large external creditor facing domestic pressure and repatriating capital, triggering asset price corrections in the recipient economy. The historical irony, and it's genuinely novel, is that the United States is now the recipient economy running the sudden stop risk from the sovereign states. This is not how the textbook wrote it. AI CapEx dependency. The bar chart makes this point visually, but I'll give you the numbers to narrate it properly. The big 5 hyperscalers, Amazon, Alphabet, Meta, Microsoft and Oracle, are projected to spend $680 billion on AI CapEx in 2026 alone. Wall Street analysts at the Bank of America and Evercore now project total AI CapEx to exceed $1 trillion in 2027. The critical structural shift. Since late 2024, most hyperscalers have moved from cash flow funded CapEx to investment grade debt issuance. They are borrowing to build. The problem? AI related services are expected to deliver only about $25 billion in revenue in 2026, roughly 10% of what the hyperscalers are spending on infrastructure. Fewer than 1 in 4 AI initiatives have delivered expected ROI. The connection to the GCC capital is direct. GCC central banks, distinct from the sovereign wealth funds, have historically been large buyers of US Treasury bonds and investment-grade corporate credit, exactly the instruments hyperscalers are now issuing to fund their capex. If GCC central bank reserves are being drawn down to support domestic fiscal needs, They are simultaneously buying fewer of these bonds, putting upward pressure on yields and corporate spreads. BlackRock's Investment Direction Survey, January of this year, is worth citing. Only 1 in 5 institutional investors now see large cap US tech as the most compelling AI investment opportunity. More than half backed energy and infrastructure providers instead. The smart money is already rotating away from the hyperscalers. Okay, this slide I won't go through it all. If you're interested, put it on pause and have a look. These are just the Friar's active and watch list tickers. Okay, what to watch? The IPO window is the empirical test of the entire GCC Silicon Valley capital pipeline. First, PIF 13F filings confirmed. Q1 2026 is filed and we have covered it in detail. The Q2 2026 filings will be the next data point, expected in August. If the portfolio drops below $11 billion and holdings fall to 3 or fewer companies, the acceleration thesis is confirmed. Number 2, SpaceX IPO anchor confirmation. The S1 prospectus has been filed. Watch for the anchor investor disclosure section. Does PIF appear as a $5 billion anchor? Is the figure reduced? Has it been restructured as a post-IPO commitment rather than a pre-IPO anchor? Any of these alternatives is informative. 3, hyperscaler debt issuance. Monitor investment-grade bond spreads for Microsoft, Amazon, Google, and Meta. Widening spreads indicate the market is demanding a higher cost of capital for AI infrastructure debt. This is the canary for multiple compression. Number 4, Q technicals. Friar's January 27 put is held. We are watching for algo confirmation of trend crossover. MACD histogram reversal below the 0 line, stochastic crossing below 50, and a 20 EMA crossing below 50 EMA on the weekly chart would be the doctrine's grade confirmation we need to add to the position. Number 5, GCC credit ratings. Moody's has already moved on Bahrain. Watch S&P and Fitch on Kuwait, Oman, and Qatar, all of which have meaningful US equity holdings through their sovereign wealth funds. Further downgrades accelerate the repatriation timeline. And 6, Hormuz resolution versus escalation. The Iran-Oman Joint Strait Management Proposal is in play. If it advances towards a working agreement, the Hormuz disruption thesis weakens, and we must reassess our energy and commodity longs. If the conflict escalates, every bear structure in the positioning table moves towards entry.